And I would like to invite our second team to the stage, Prime Capital Thinkers. Please let's welcome them to the stage.
Good afternoon, everyone. We are presenting your investment thesis on Verizon Corporation Incorporated. Based on the valuations we did and our equity researches, we believe Verizon stock is highly undervalued. We base our price target to $50, showing an uphill compelling price of 21% upgrade than the current state. We are the Prime Capital Thinkers. My name is Kalkiran Hailo. This is my team, Emmanuel, Dana, and Hannah. We will now be presenting our pitch.
Starting with the company overview of Verizon. Verizon is a global leader in communications and wireless and broadband and business service in nationwide, especially in US. And when you see the stock performance level, Verizon is decline price from $60 in 2022 to $40 in 2024. And this creates an attractive entry level. And when you see the management level, Verizon is restructuring in 2025 by appointing Dan Shellman as CEO. He brings us the strategic leadership and efficiencies and gross profit on consumer and business segments. And when we look at the industry level or its total addressable market, Verizon expand its total addressable market from $1.7 billion in 2022 to approximately $2 trillion in 2024.
Going through our investment thesis, we categorized it into structured three. The first is a 5G monetization story. The second is cash flow compounders and the network quality. So seeing the 5G mobilization story, we categorize this as we have like the United States broadband is still growing, showing a very high success for subscription and revenue growth. So we are projecting by 2026, they will have a subscribers to 7 to 8 million subscribers, increasing their revenue sources as well. This monetization story is inspiring investment thesis because we see about from 80 billion revenue source, which only accommodates their 13% of their revenue source into almost 30 billion by in the end of 2026, which would accommodate the 20% of their revenue source. The second is their cash flow compounder, seeing that they have a very consistent 18 years of dividend payouts to their shareholders. This is approximately securing by 6.5 margin of high yield dividend compounders than any other S&P we've seen. On average, 1.5 for the other S&Ps. So this sustainable 75 growth, they will accommodate it to their sustainable 5G mobilization that they have been growing about $200 billion right now. And the other is their free cash flow over the years. They generated about 20 billion. So this shows their prospectus is growing right now. And the last will be the network quality mold. So Verizon's network quality mold is very reliable, seeing the coverages both on the network qualities, call qualities, coverage, reliability, rather than their other competitors in the sector. They shows that in two advantages. So we see the spectrum advantage, seeing that they have a 2 to 3 years first movers advantage in the spectrum. They have more than 50 billion C-band investment. This shows they have a very high ideal band to the 5G monetization. And the other is their business segments of their revenue resource, B2B, or we can call it the enterprise lock-in. They provide services to businesses, government clients, and this reliability of their network translates into a long-term reliable connections, and this makes them a very reliable, and even the pricing power they have in the market will be big.
Now I'll tell you about the valuation and the comparable analysis. Verizon is currently traded at $41 share price, and based on our intrinsic DCA valuation, we project it will reach around 50 share dollar price, and based on our peer comparative analysis, it has a potential to reach around $59 dollar price. Now, when we see our intrinsic DCA valuation, we projected three cases: the bull case, the base case, and the bear case. In our base case, we used an EBITDA multiple of 8.0 and a WACC of 5.76, and we projected the share price to be $50, which is a 21% upside. And in our bear case, which is our pessimistic case, we developed an EBITDA of 7.0 with a WACC of the same 5.76, and we reached a share price of $44, which is a 4.2% upside. And in our bull case, which is our most optimistic case, we used an EBITDA of 9.0 times and a WACC of 5.76, and we reached a valuation price of $59 share price. And when we come to our comparable analysis, we can see that Verizon is first in return on equity, it's first in return on invested capital, it's first in dividend yield, and it's also first in network quality. It's only second best to T-Mobile in EBITDA multiple. In EBITDA margin, they are almost the same. But when we see the valuation difference, T-Mobile is being traded around $207, and Verizon is around 41 at the current rate, and we see a high valuation difference. And once the market realizes this, it will increase the share price of Verizon. And when we did our valuation, we saw some points like the revenue has been growing over the years by 1 up to 1.5%, and we saw also the operating cash flow, which has been over 37 billion over the past 3 years, and we also saw the free cash flow, which has increased by 53% from 2023 to 2024. So based on these cases, we recommend a strong buy.
Okay, now we'll look at the risks and catalysts that Verizon faces. So one of the most important catalysts for Verizon is the fixed wireless access growth. If Verizon continues to add 400,000 subscribers per quarter, then this will lead to a support in their revenue margin expansion, and it also shows it's taking share from cables. The second catalyst is continued dividend growth. So Verizon has been increasing its dividend for 18 straight years. The other one is potential interest rate cuts. So even a small rate cut can lead to Verizon reducing its interest expense and in its debt load. The other is enterprise wins, especially 5G private contracts. So each deal here brings higher value customers, and it also proves that Verizon's 5G investments have been showing returns. So now let's look at the risks. So the core risk is price competition with T-Mobile's aggressive Un-carrier strategy and low-priced MVNO plans, cable plans. And so to mitigate this, Verizon emphasizes premium unlimited plans and network quality. The next risk is capital intensity. Telecoms are highly capital intensive. But for Verizon, after the 5G rollout, CapEx has been declining. The next one is 5G monetization delay. So slower than expected 5G monetization might happen. So to mitigate this, Verizon is expanding its fixed wireless access coverage and it's accelerating enterprise partnerships. Thank you.
As Prime Capital Thinkers, this will be all our equity research and financial analysis we did on Verizon Communication Incorporated. Thank you for listening to us, and we're now open to questions.
Thank you. So it was a very clear presentation, and the investment thesis came across, I think, strongly. And you laid out why you think it's undervalued. But can you explain to me why you think the market has missed this? What is it about this stock in the context of that sector that the market itself doesn't understand?
About this stock, the market doesn't understand?
Yeah, so it's undervalued. I mean, this is a stock that looks like a bond. right? It's reasonably straightforward to value it.
The market is not considering our, for example, the dividend yield, which is Verizon is the highest in the market. It's better than T-Mobile. It's better than AT&T, and we can also see return on equity. And the market is also not seeing what Verizon is doing in 2025. For example.
So my question is, why are they not seeing it?
Huh?
Why do they not see these things?
Because I think their matrix is different. They are not including these matrices in their, like when they compare companies, they are using other matrices, like, for example, revenue growth. For example, if we see T-Mobile, the revenue growth of T-Mobile is higher than Verizon at this time. And we are saying like the revenue growth will increase. For example, now Verizon is like is growing at 1 or 1.5%, but in the future it will grow 3 to 4% based on its projects like the 5G monetization project, and it's also expanding its cost cutting. For example, in 2025, it has cut some of its workers just to decrease its cost, and this will also help it to cover some of its debt. And I think this is the reason the market is undervaluing it. But when the market says the other reasons, I think it will value it at the right price, which we have projected.
To add a little bit on it, they have been investing a lot. They have been changing their 5G capex to harvesting it to investment. And this has been taken about $200 billion. It's not a small investment, it's taking time. And seeing that even iPhone, even Apple is going to the telecommunication market. So other cable companies are cutting the market. So like they still have a loyal premium plan companies and clients, home-based clients, who want to invest in the fixed wireless access. And based on what we see on our equity research, still 10 to 15% of their clients are paying premium monthly payments, and this shows a great prospectus on their end.
Thank you very much. Maybe I can go next. Very good presentation. Thank you very much for that. The first thing is telcos are under pressure from competition, as you know. The competition is not only coming from the telcos themselves, but also from the different perspective, from fintechs, banks, and now other service providers. And majority of the telcos revenue come from data, and as you have mentioned rightly as well. One of my question is, have you considered the impact of competition, especially from the likes of Starlink and the others, on Verizon's long-term revenue? That's the first one. Second is, Verizon is a global player. Have you considered global expansion, other markets, the impact of those markets into your investment thesis? Thank you very much.
So to dwell on the first question a little bit, we did consider their competitive markets within the market share of other T-Mobiles and other competitors as well. But there are very small companies, cable companies, entering the market that are undercutting their price. When we saw the performance of the financial stock performance of the last few years, it has declined by $21, seeing that they had a high debt. The high debt, referring to like they have been capitalizing on largely on the 5G mobilization, but they still were paying out dividend. So some people took that as they are going to leave the market, so it's better to sell it right now and leave the market. So seeing the competitor side, you are right. But the projectors and others think we are in a world where there is a technology of everything is technology, everything is wireless access right now. So seeing the reference to that, even if there is a competitor, the telecommunication is never-ending cycle of the world, and we're going to be, I think, have to go back to the comparable analysis to see how they were performing in the last years.
On the second question, which is their global expansion, Verizon mainly works in the United States of America, and most of its revenue comes from the United States of America. So we try to concentrate on the United States of America because most of its shareholders are in the United States of America. Its revenue is mostly concentrated in the United States of America. So we try to stay from the competitor side, which are in the United States. But in the future, Verizon is also planning to expand globally, and that global expansion will give it its competitive edge. And also, the global expansion will increase its revenue, and as you know, that's also one of our reasons to project it to our bullish case share price, which will be around $59 if this will be included.
You said, or you indicated in your numbers, that there is a dividend payout ratio of 6.5%. So, yeah, is this going to be an advantage for the company or a disadvantage? Because this is an industry where you need significant investment every year. So is it going to be an advantage or a disadvantage? Or generally, are we going to consider this as a dividend stock? Shall I buy this stock as dividend stock or just for the sake of its market capitalization?
I think you should consider it as a dividend stock because the dividend yield is 6.5%. So as an investor, this is a really, when you see 6.5% yield, which other companies are not offering, it will be very attractive for an investor because you'll get your money very, very soon if the dividend yield is high. But as you said, from the company's point of view, giving high dividend yield may affect its capital expenditure. But Verizon is covering its capital expenditures through other means. For example, its cash flow is really high. As I said, in 2023 to 2024, it has increased by 53%. From 15.1 billion to 24.4 billion, the cash flow has increased. So this will cover some parts, and also Verizon covers some of its capital expenditures through debt. So it will not affect the dividend yield. So it will cover it from its cash flow and from its debt. So it will not affect that.
Thank you so much. I got a couple of questions here. First of all, you know that there is a Starlink in the United States that's probably going to enter the market as well. So it's a satellite Starlink connection, and a lot of people are looking into that. I didn't see that mentioned, so perhaps maybe you can tell me if that's also considered as a competitor. The other thing is I didn't see research and development of what is Verizon doing to improve just not 5G, but the usage of 5G. And the third question is I didn't see the operation expense of employees, especially operational expenses in general, because as you know, United States salaries are very high. And now, especially with AI coming in, I would have expected you to say something about how it's going to reduce that and provide a balance and so forth. But I didn't see that in your presentation. So if it's missed, perhaps you can explain that to me.
Can I start from the third question?
Sure.
Yeah. About the operational expenses, as I told you, in 2025, yes, we didn't mention it in our PowerPoint. We tried to make it as small as possible. But in 2025, after the new management entered the company, it has decreased its workers by 12,000 or 13,000 workers. And they have been replaced, as you know, with technology. If the work can be done through AI, they have been replaced. And for your first question about the Starlink, which is entering the market, we try to concentrate already on the competitors that Verizon have, because Verizon has been there for about 19 years and above. So when a new company enters, yes, there will be some difficulties, but since Verizon is number one in network quality and it has retained its customers for more than 15 years, the competition that comes from Starlink is not that high because already it has competition from high-level companies, so the competition will not be that high.
We have a little more time. So to answer the second question, the 5G monetization has been going through mainly through they've been expanding the premium plan to their customers, home-based customer and business customers, because the enterprise customers more or less are their businesses and governments who have a huge capital and are mobilizing different capitals per day. And the other is the enterprises working on the business segments, and the fixed wireless access still is expanding in the United States.
Thank you so much, Team 2.